All right, it is Yield Nerd season again, and I titled this Yield Super Bowl, but in reality, there is a surprise that is not on the charts of the traditional Yield Super Bowl. Let me explain more as we go along. A couple of housekeeping things. Thank you for new subscribers. Please make sure you use the roadmap, which is a playlist, and it organizes things in sequential order. And my usual disclaimers, I am not a tax accountant. I am not your wealth management advisor. I do not have any agenda, and I certainly am not here to preach product or politics. This is education. All right, here is how I thought we could organize today's episode. The very first part, we're just going to do a quick recap of where we are in the interest rate environment, and we're going to play our infamous Yield Super Bowl again. Maybe it should be called Yield US Open to recognize, or Yield Wimbledon rather. And we're going to see what the value investment side is all about and what are the signals being sent from there. And it is my humble opinion that we are getting ready for the next storm clouds. I say that right as there is thunder in the distance. And there are real storm clouds ahead, but that is unlikely to affect your bond portfolio. The storm clouds I'm talking about may. And then we'll end with what do we do over the next 90 days and how can a reasonable yield nerd prepare for it. The background, we've been going up and up on interest rates, and the Fed has signaled that they will continue to increase it until their inflation target is roughly 2%. And the indications are we may or be near the peak. Nobody knows. I mean, nobody thinks it'll go up another 4 or 5%. But at the same time, it may go up another 1/4%, 0.5%. Who knows? We don't know. You don't know. I don't know. But we just have to plan based on reasonable assumptions. It is highly unlikely, however, that rates are going to drop anytime soon. Now, that is, barring any unforeseen events, global catastrophes, that sort of thing. Outside of that, rates are probably going to be stuck where they are for a reasonable period of time until the Fed knows that their fight against inflation has succeeded. At least that is what they're telling us now. So having said that, let's play Yield Super Bowl and see what has happened now that we are approaching what we are told could be the highest amount or the peak interest rates. A couple of reminders on Yield Super Bowl. What we used to do is take the various fixed income instruments and compare them. And during the Silicon Valley bank crash, and there is a previous episode, if you want to go check that episode, it will talk about how bank CDs showed up out of nowhere and disrupted our thesis of what the best instrument is. And that happened for a very brief period. You are welcome to check out the past episodes. I will post a link right there that talks about what bank CDs did before. Having said that, the way we do it is we pick each duration from 3 months all the way to 20 years. And for each duration, we look at which instrument is best, including bank CDs, of course. And we would then look at the pre-tax yield, and the reasons for doing pre-tax yield are their own, and you would have to look at other historical episodes to understand that. Since treasuries are state tax exempt, we would bump up the treasury yields by the state tax. And agencies and certain exceptions, we'd bump those up as well. Munis would be bumped up by the federal tax rate, except we use effective tax, not marginal tax. Corporate yields are kept the same, and same for CDs. And again, if you look at past episodes, you will understand which agency bonds are and which ones are not state taxable. And so, having said all of that, let's play Yield Super Bowl as of today, which is July 11th, 2023. Ready? Here is how it looks. And let me quickly annotate it. In the short run, 3 months, 6 months, and all the way up to 9 months, treasuries still dominate the workflow. If you want as high pre-tax yield of roughly 6%, you still are going to do very well with treasuries. And what you do see, however, is bank CDs are not even in the top 4. And once you go past the 9 months into the 1 to 3 area, there is actually a couple of things that you should note. One is Treasury yields crater and drop off the face of the earth, the classic yield curve inversion, but it happens more so right after 1 year. You do see something surprising. You see that corporate bonds are in the running even on a pre-tax basis, meaning they offer more than 6% than agency bonds to make up for the fact that corporate bonds are state and federally taxable. And that initially was a surprise for me. And I started diving into what those corporate bonds are, and aha, these are banks. And so there are several banks, and I won't mention any names, that are offering 1 to 2 year bonds. They are all callable. And the reason they are callable is the bank is saying if suddenly there is a reason why interest rates drop, I'm just going to call these bonds. Otherwise, banks desperately need money. And so they are willing to go out and raise money paying top dollar. You do your math on whether you want to own those corporate bonds or not, but on a pre-tax basis, they are as good as an agency bond in that duration. And if you go longer than 2 years, agency bonds at the moment have the best yield. And again, you have to look at some of the caveats. We talked about it. But again, all those agency bonds are callable. And the reason I keep talking about callable is you may think you have locked in the 6.25% interest rate or whatever it may be, and 3 months later, they may get called. Maybe they get called 6 months later. But unless you think interest rates are going to stay at 6% for 4 and 5 years, and I don't know whether they will, all odds are they may not, but you do you. The odds of a 5 year bond, that an agency bond paying 6.25% going to maturity seems pretty low to me, but what do I know? So we kind of come down to this. If you want 6%-ish pre-tax, you can do treasuries. You could, if you're brave, do some callable bank corporate bonds. And if you want to increase duration, you can pretend you increase duration but buy agency bonds, but these are callable, so in all likelihood they are going to evaporate. So that's my thesis. So here is what I'm thinking through. In the short run, in the short duration, I'm just going to focus on treasuries. I might grab an agency bond here and an agency bond there if the yield is absolutely spectacular, 6.25% or north of that. However, I am a little bit nervous about the fact that every agency bond I buy is a Federal Farm Credit Bureau or a Federal Home Lending Bureau. So to keep buying the same agency bond, or different issues of the same bond kind of make me wonder, is that the right thing to do? That's just my thought process. And so that makes me want to look at where else can I get similar yields or somewhat closer yields. And that is our next step. So you may remember I have been mentioning in previous episodes as well that I've started dabbling into some value investing. I thought I'd put some structure into it and explain what I'm doing. You do you. Now, what is the value baby? And that's the yield nerd baby. That's baby yield nerd. It's kind of like baby Yoda, if you will. A good value investment, the company would have ideally no debt or very, very low debt. They should have low enterprise value. If that term does not make sense, you will need to see a previous episode where I walk you through how to compute enterprise value. And the company should ideally have a low PE ratio, meaning their stock has to be somewhat cheap. They should have very high cash flow. The definition of cash flow in acronym terms is EBIT plus DA, meaning it is earnings before interest after taxes plus depreciation and amortization. The folks here that are knowledgeable in finance will know that depreciation and amortization are non-cash expenses. So money doesn't really leave the bank account. So cash flow is a way to look at how much money did you really have left, real cold hard cash. And so EBIT is after you pay taxes and before you pay interest, earnings before interest after taxes, plus depreciation and amortization, add back the non-cash expense. That is the money you have to pay dividends. That is the money you have to pay, any other stuff that you want to pay, invest, and so on. So if a company generates high cash flow and is very profitable, that's a good deal. And if they also pay a good dividend, odds are they can afford to keep paying that good dividend because they have good cash flow, as long as their dividend coverage ratio is good, and hopefully you're not paying top dollar for every dollar of cash flow. And there is a lot of trading volume, so if you do want to exit, you are able to exit. All right. I am using Schwab.com. I forgot to put that on the screen. You use whatever you want to put, but here is a screener. And here is how you can express it. Number one, I said I want volume greater than 50,000 in the last 10 days. Anything lower than that, you may want to sell it, but you may be stuck. I did say I want an extremely high coverage ratio. Why is that needed? This way I know that the odds of the dividend decreasing are really, really low. This is the debt filter. I started with no debt and debt to equity ratio less than 1. The average debt to equity ratio of publicly traded companies today is 0.3. So if I had an ability to say, give me debt to equity ratio less than 0.2, I would have done that. But at least on Schwab.com, you go from no debt to less than 1, which is terrible. So I would not personally invest in a company whose debt to equity ratio is greater than 0.3, meaning higher than average, but you do you. The next thing I look for is companies that have a cash flow per share that are well above the average. I'd love for them to pay me a little bit of dividends, and I want them to be very, very cheap, meaning their PE ratio is very cheap. The average PE ratio of a publicly traded company is 22. And if I can find companies whose PE ratios are less than 10, I know I'm getting a cash cow type company and I'm not paying a lot for it. And as you can see, there are 98 companies. In this scenario, we are optimizing high cash flow and low PE ratio. Here is another version. Here, we're going to say, well, I want the dividends, but I'm willing to give up something else. So let's see what we are giving up here. This one says, I still want the very high coverage ratio on the volume, but I don't want any debt whatsoever. And I'm willing to look at companies with very low cash flow per share as long as they pay a lot in dividends. And I still don't want to pay a lot per share. And as you can see, this produces a really small list, a really short list. It is not my position to go through each of those companies that meet the criteria. Remember, and again, you may want to look at one of the past episodes where some of the companies that show up in those filter are those that have been completely shut down and non-existent. So don't believe everything that comes. You still have to do due diligence on each of them. I am about to discuss specific companies. I want to make sure I declare conflicts of interest. I may own some of them, I may buy some of them later, I may sell some of them later. I'm only giving you education on specific examples. You need to make your own decision. These are not stock recommendations. You do you. All right, here is one, EPM, Evolution Petroleum. As you can see, the market cap is nothing. The mega caps, as we call it, the Microsoft, the Facebooks, they are in the trillions, and this one is a couple of $100 million. But here is an interesting anecdote. Their enterprise value is less than their market cap. And if you listen to previous episodes, you will know that that means this company has a lot of cash in the bank and low debt, or a combination of both of them. Their PE ratio is single digits, which is pretty amazing. Their dividends are very high. And there is also another note, and one of the Yield Nerd subscribers wanted to know, how do I tell that a dividend is a qualified dividend? And here is the answer. If you own a security, an equity, for more than 3 months, then your dividends become qualified as long as the issuing entity is not a trust. Any dividend given by a trust is not qualified. They're called cash dividends, so they are taxed the way ordinary income would be taxed. Real estate investment trusts, REITs, belong to the same category. Some preferreds, generally almost all preferreds, also only give cash dividends. Many ETFs, go check. Many ETFs give cash dividends. So you think you're buying into income stocks. Well, It's not always true. You're really buying ETFs that give dividends, which are cash dividends. So you're paying a high tax. So you have to be very careful owning ETFs. I personally do not buy them anymore, and you do you. And so when you buy these dividends, if your effective tax rate is X, your new effective tax rate is the capital gains tax rate. As long as your effective tax rate is greater than your capital gains tax rate, you are actually saving in taxes by owning individual equities that pay qualified dividends. So that's an interesting thing there. Couple of other things. EPM has no debt whatsoever. Very nice. They do have a very high cash flow margin. They have a very high cash flow. They don't have a lot of cash per share, but in general, pipeline companies, royalty companies don't maintain cash, so they just issue it as dividends. Their dividend coverage ratio is fantastic. That hopefully means that they can still cover the dividend even if there is a low quarter or so. And my conclusion, and you make your own conclusion, is that it's a cheap stock that pays good dividends that are qualified. However, there is a big exposure to recession. This is a micro cap, so they may get crushed. The fluctuation of oil prices will affect them, so it has its pros and cons. Let's go on to the second one. In this case, I use the second screener where I go after not dividends, but cash flow and hope that the particular security would appreciate. And again, this is just my thesis. MLI is several $billion in market cap, again, has a ton of cash, low PE ratio. They don't really issue a lot in dividends. They barely have any debt. And as you can see, they could afford to give a whole lot more in dividends. They just choose not to give it. That potentially could give them the opportunity to go acquire other companies when there is a downfall. And so this is a cheap stock that can grow dividends. However, in a recession, it may or may not be exposed. So that is something for you to think about. These are examples of how to analyze value investments. So are we then clear to go buy any and all equities? Are we ready? And my answer for my own research is nope. And here's why. You may remember there was a bipartisan debt ceiling bill that increased the ability of the government to borrow, except we don't have an unfettered ability to spend the amount that was borrowed. So there still are major differences to be ironed out. There is a previous episode where I mentioned September 30th as the deadline. It is becoming more and more real. So there is a possibility, however remote, that there could be a government shutdown starting October 1st. As we approach that deadline, there may be some rattles in the market. There may be some equity related issues, equities that are dependent on government spending may get affected. There may be a debt ceiling moment where Treasury yields suddenly go higher, or this may just be another blink of the eye and a bipartisan omnibus bill goes through. I don't know, and you don't know. If you know, please tell me. But the idea that you can just go rush to buy value investments now seems rushed to me. I certainly am not going to do that. So what does this all mean for the next 90 days? It all probably points towards keeping some dry powder handy around October 1st. If you find a value investment that you absolutely cannot pass up, that may be interesting to buy. Otherwise, I personally would still sit on treasuries short term and wait and see how September 30th goes in terms of the government shutdown. Questions, comments, happy to answer them. Thank you for listening to Yield Nerd.